It's go time.
And we're live. We're running this one on sticky tape and twine. Bill's on his phone. JT's in his bunker in the Caribbean, getting ready for Armageddon. I'm stuck where I always am, in the middle with these guys. How's everybody doing?
I've had better days.
It's 10:30 a.m. on the West Coast, 1:30 p.m. East Coast, 6:30 a.m. Australian Eastern Standard. I think it's 6:30 p.m. UTC. We're live. If you want to catch us live, just go to the YouTube channel, click subscribe, get a notification.
January 19th, I guess some people were asking for a little date notification during, if they're not catching it live. So there you go.
Yeah, I don't like to do the date notifications, so then you don't know how old it is when you hear it in the audio.
All right, well, never mind. Forget that.
Townsville's in town. What's up, Queensland? Dubai, 10:30 p.m. in Dubai. Lithuania, 8:30 p.m. There we go.
You think we're going to do this for like years? You think in 2 years we're still going to be shouting out? I'll tell you what, in 2 years, if we don't get paid, I'm going to be broke as a joke.
More so. Yeah, shout out to the Indians who pulled one out at the Gabba, my home cricket ground, and get to watch this one because I'm over here. And they don't air it in the States. Shocking. Don't air Test cricket in the States. They don't air the Australia-India game. You would think that'd be prime time.
I don't even know what you're talking
that.
about.
That's all right. This is for the Indians on the pod and the Aussies. What are we talking about today, gents?
Bill, what do you got?
I don't know. I was probably going to talk about the Howard Marks letter and general Compound Town.
I have Ketchup physics is what I'm calling this one. So
I like that. Are you going to discuss the Pabrai letter?
No.
Oh.
But you can.
Well, I'll discuss the Pabrai letter and some of the takeaways that I have from it more generally. I didn't read it in its entirety because I thought that one of you guys was going to discuss it, but I did skim it right after this. Who wants to go first?
Well, my understanding of the Pabrai letter and Mark's letter is pretty similar, right? In that they're sort of maybe both opening their mind up to Compound Town a little bit more in these compounders versus maybe what has been historically statistically cheap stuff. And I guess that, I think that the thing that people need to at least look at a decade of performance and contemplate is, are value investors a little bit too preoccupied with the downside? Jake got up and left. That's how much he likes this. He said, I'm out. I'm done.
Can't handle it.
Yeah, but would it? I mean, I think it almost certainly would have served people better to focus on the upside rather than the downside, and say, if I have 10 bets, if I'm right on the upside on one of these, it'll bail me out of the ones that won't work. I guess the tough question is, are we at the point in the cycle where that continues to be a good bet or no? And I guess that's where it's somewhat interesting to see. At least I didn't read that letter as if he's saying, one way is right or the other. I read it more of a letter of saying I used to maybe lean towards saying that one was definitely right, and now I'm at least open to the idea that there's a different way to skin the cat. And, I do think if you want to see capitulation in it, you can. I'm not sure that's what I actually saw. But, it's, look, man, it's the stuff I've been talking about for a while. So it's what Twitter did for me. And I think that now you're starting to see some other guys come out and say it. It's just sort of an interesting time to say it.
I'm going to be Statler or Waldorf for this one. I'm throwing fruit. I'm not a fan. This is just, nobody can withstand it. Everybody gets that point in the cycle where they just say, take the pain away. I want to buy the stuff that's going up. I'm sick of buying the stuff that's going down. I've been having this conversation for a little while. I know we talked about it on Bill's podcast, and I've seen some of the comments where folks think that I'm trying to transition to a Buffett style. I'm not at all. I just want to be very clear about what I think has happened. I think that the high quality stuff has had an absolute blockbuster run, but that's not unprecedented. It happens basically at the tail end of every cycle, that quality does a lot better than value. Value just sort of treads water through the tail end. I think you can go back and, this is one of the things that I've pointed out before. When you compare the magic formula, which is a very simple quantitative expression of what Buffett does, high return on equity, return on invested capital, doesn't really matter, as a quality metric, and then sort of like a acquirer's multiple, he calls it EBIT earnings yield, I call it acquirer's multiple. Doesn't matter if you use EBITDA or EBIT, all gives you operating earnings, doesn't matter, it all gives you roughly the same answer. Just some value metric versus some sort of quality metric. Combine them together, most of the time the value metric does better. However, there are periods of time, like the late 1990s and now, where having the quality metric helps you out. So I've cut this test a number of different ways. I tried it, I've been running it for the last few weeks. Just what is it? So we could all agree on a definition of a high quality company, right? We would say sustainable returns on equity, kind of north of 20%, sustainable gross margins, 30 to 35% or greater. And if you look at a list of those companies, they're all the quality companies that we would all agree. There's Microsoft. You'll find some stuff in there like Intel and Biogen. You find some cheap stuff in there too, but they're pretty good high quality companies. And if you buy those high quality companies cheap enough and you hold them for the long term, you get very good returns. But the time to do that is when they're cheap and not when they're expensive. And we're at the point in the cycle where quality has started getting expensive. And I just think the best opportunities right now are in deep value. Like objectively, the better opportunities are there. I'm like probably going to be the last guy. Pabrai's gone, Howard Marks is gone. It'll be JT and I will be the only, the last two guys left on the island in the Pacific thinking that World War II is going on.
Well, I mean, I love to see these kinds of things, because to me, that's who is left to turn over at that point. Who's left to sandbag it? There's hardly anybody. And that's usually a pretty good sign that you're at a turning point. So I love it. I want more of those. Every time they declare Buffett's lost it, he hasn't. Every time value's probably been declared dead, it probably hasn't. I mean, this is just the game. Like, you just have to be willing to roll with it.
I think we're at that point in the cycle though, where it is very tempting to do that. I do understand. I'm not criticizing anybody. I do understand why you do it, because it sucks going backwards, and particularly when everybody else is going forwards. But I think part of being an investor is taking a step back and having a look at the full cycle and understanding where we are in the cycle. And where we are in the cycle is, I don't know if it's the tail end of a bull market, because I don't want to say it's the tail end, because that presupposes that I know exactly where we are in the cycle. We're not, but we're not. It's not March 2009, and March 2020 was not March 2009. It was still an expensive market. It pulled back. It bounced like a golf ball off a concrete path, but it certainly wasn't bouncing off undervaluation at that point. It's just bouncing because that's sometimes what happens when the market takes a swan dive. It rips higher. I don't think this cycle is over by any stretch of the imagination, and I certainly don't think March 2020 will prove to be the low point in this cycle. No one wants to dive on that grenade.
No, I
letting
mean,
Bill
I'm
gather
just
his
thinking
thoughts.
I'm just thinking about it. I mean, I guess that the thing that I think is an error, I don't think that you can look at 2009, which was a liquidity crisis, and say, well, if we don't get back there, we're not cheap. And then if you look at 2009 and you say, well, we weren't even that cheap in 2009, then, I mean, I guess that the only thing that I would say is then you better not have much allocated to equities, because if that's what you're waiting for, there's going to be nowhere to hide, and you might as well just be in cash. So, if that's the bet, but it's not like value is going to be spared in that kind of a downturn. It may just get its, ass kicked a little bit less. But like, I don't know. I have conflicting thoughts. I mean, I've been doing a little bit of work on Planet Fitness, and I mean, that valuation, if people can walk me through a reasonable way to get double digits from here, I'd love to hear it. And I'm not even saying that like I know one and I have a view. I'm saying like, please help my mind figure it out because I can't figure it out. Other than heaping like a massive terminal value on something, which, you know, can work and has worked, but I don't know that it's how I want to invest. So I guess it's nuanced, right? I think that the tough thing for somebody that wants the underlying cash flow and they want a juicy yield is it sort of doesn't exist right now, at least not in anything quality. Now there are some things, right? And that's why I had said, you know, earlier in the week, I had tweeted out like, get off your ass and start studying businesses, because I do think that there's, you know, some interesting ideas out there, and they're probably smaller and they're undiscovered, and some of them might be in foreign markets, and it may require talking to a lot of people to try to get your head around how it actually works. And maybe you can't get there. I don't know. Maybe you're just putting in the reps for nothing today, but down the road, you'll have the work done. That's more where my head's at. I have no idea. I mean, I still think we're probably closer to the beginning than the end of the melt up, but that's only because I think it can get crazy.
Crazier?
What?
Crazy.
I mean, what's crazy?
Oh, we're in crazy.
I don't know, man. I mean, I don't know.
What's your definition of crazy, Bill? Because here's what I see. I get like,
I told you Apple at 5 trillion is where I will tell you that I think we're in rich territory, like objectively rich territory. I've been saying that for 2 fucking years now. It's like you guys aren't listening to me.
So, but that's one. So your indicator is one stock at $5 trillion. Can we get anything a little bit more robust, a little bit more broader based? Like Schiller Capes at 35. Like that's really exceeded. And the reason is that interest rates are pinned close to zero.
Rates
are backing up a little bit. They got rates. The 10 years backed up a little bit, and it's helped deep value run a little bit more recently.
Yeah, I mean, look, I guess that the best thing that I can tell you is that the way that I look at my portfolio is I have cigarettes for near duration cash flow. I have some energy MLPs as bond substitutes. I have some quality out there. My biggest position right now is Berkshire, followed by Curate. Curate is objectively near duration cash flows. I mean, I don't have like a ton of duration risk that I'm taking throughout my portfolio, but I've also, you know, been fortunate enough to talk to some people that I know are thoughtful, like Shomik at Minion Capital. Like that guy's not a dummy, and he thinks that, you know, there are reasonable arguments to be made for the valuations in the names that he has. Now, you know,
everybody thinks he owns undervalued.
Yeah,
I understand that, but I'm just saying, if you haven't done the work, dismissing the valuation because you haven't done the work is something that I'm done with. Do I think it's rich? Yeah. Do I understand it? No. But I'm not going to do that shit anymore because it turns my brain off and it's cost me a lot of money.
I don't disagree with that at all. I think just more generally, if we're trying to ascertain base rates of what we can kind of expect going forward, I just don't like the setup relative to other times. And I think there will absolutely be chances to, you know, be like a really good sniper and have the rifle and take good shots. But I kind of like it better, and I find it easier when I can use a shotgun because it's like it's just become so obvious because of valuations. I don't have to be as smart about it. Like I can be a pretty shitty analyst if I have the right amount of patience to pair with it. And I think all these other things, right? A lot of things right now require you to be an absolutely incredible analyst in order to have a good shot at a good outcome. And I'm just not sure that I have that kind of capability.
Yeah, that's basically where I get to too. When you look at the list of things that are high quality, so that definition that I gave before, ROE over 20%, gross margins over 35%, and then rank them all on cheapness, and you get names like Biogen and Intel. I think that those things probably do work out, but you know, you have to. I'm no pharma analyst, and they're pretty good. You know, there are smart people who think that Intel is a value trap here. So. It does, like, there's nothing in there that's just an obvious, easy, simple business that's cheap, that's got a solid balance sheet. like everything's financialized too. That's the most frustrating thing. Everything I look at, like they're optimizing for the, they're optimizing rather than kind of trying to build in some resilience, which I just think all of that stuff is the stuff that you see close to the top of the cycle, and everybody gets religion. I mean, I'm stunned that nobody got religion after March last year. Everybody was pausing and they were like, oh, stop the buybacks for a moment. Not so much debt. And then they're like, oh, no, don't worry about that. That was over so quickly. That was just an opportunity. Buy the dip.
I'm invincible.
Well, I guess at like 2009, you got paid for being a liquidity provider. And in March, you somewhat did. But I just think that we're at the point where the Fed is going to provide the liquidity. So I don't know that you're going to get paid for that. So then the question that I ask is like, okay, well, it's the old Chris Cole thing. Like, so where the hell does it go to? Like, you can't suppress the risk. So I don't know where the risk is, but I'm just not sure it's in equity valuations broadly. That said, I don't expect very good future returns. It's something that keeps me up at night.
Well, Hussman today suggests that they're negative over 12 years. Using his,
I mean, Hussman's been wrong forever.
But I think that you can separate out. I don't even really want to separate out the man. I don't think he's been wrong. I just think he's unfortunately for him, he's trying to apply some science and mathematics and like reasonability to it, whereas the market
you give me shit. No. You give me shit about people that own their stuff think it's cheap. People that agree with somebody obviously don't think they're wrong.
Yeah, that's fair.
There's a great quote from J.K. Pabrai, and it's faced with a choice between changing one's mind and proving there's no need to do so, almost everyone gets busy with the proof.
That's fair. That's fair. But
that is a good quote.
Husband cops a lot of grief on Twitter, and I think a lot of it's unfair because it's not like nobody's disputing his numbers. Nobody's arguing with him about his numbers. They're arguing about his interpretation of it. And I look at his interpretation, that chart, the relationship, whether you use it 12-year, you're assuming that you mean revert back to normalized valuations over 12 years or 10 years. I do it with 10 years just because it feels a little less sort of data mined to me. I just assume that valuations go back to the long run valuation over a decade. And the fit is good enough for me. That's a pretty good fit. And that little model says that the expected return on the S&P 500 from here is 9%, including 1.5% a year in dividends. So the index return is negative to the tune of like 0.6% over a decade. And that assumes underlying growth in the order of 6%, or underlying earnings growth. It's just that we've got so far ahead of the ordinary multiples in the Schiller Cape that we're likely to see very modest returns in the future, with a lot of volatility in the interim.
So tell me where this thought process is wrong, because this is something that I've been thinking about forever, and I just might not be understanding how the world works. If I'm looking at somebody like Planet Fitness today, and I have no working computers here, and I'm dealing with closing a home and stuff is going wrong with the deed. So I apologize if my brain is jumbled. But if I'm paying $7 billion today for like this earnings space, I get paid on my $7 billion that I paid, right? And then I get the business's return on the growth. But if the business's return is pretty small relative to the $7 billion that I paid, I'm not going to do too well, right? Or do I just not understand how investing works?
Might be too many moving parts for my adult brain, but you're going to get the return. You're ignoring what the stock market does. Like you're buying a return, right? You're buying an underlying yield and growth story.
Yeah, this goes back to the Buffett Kraft Heinz thing, right? Like he paid a lot for a substantial earnings base. And when you do that, or you pay a like a ton for a small earnings base, you really need a lot of growth to come in to bail you out if you're a cash flow guy.
Right.
And, that's where I like, so I guess that the best way that I could say it is I look at something like Texas Instruments, and I'm not a semi analyst, so I don't really know. Sorry. I've got people calling in. Anyway, I'm not a semi analyst, so I don't really know. But I think that there's a reasonable shot that a business like that does pretty well from here relative to the index. But I think some of these high flyers, I just think it's going to be very tough. But maybe it works. I don't know.
I think that there's some names in there, like in that. I look at Microsoft in my list of that, the little quality screen that I was describing before. Microsoft comes in there. I don't think Microsoft is egregiously overvalued. I think it's a little bit expensive here, but I don't think it's egregious. You can do fairly well in some of those names. And I think that there's some undervalued stuff around. I guess I'm responding a little bit to Marx and to Pabrai, where these guys have said, we've spent basically our entire careers doing, cheaper stuff. And now we think that it's time to go to Compound Town. I think the time to go to Compound Town was like 2015 when JT wrote his piece about the value opportunity spread being worse or the value opportunity being worse because the spread was so tight. Because when the best stuff is priced like the garbage stuff, which is what happened around that kind of time, then you want to be buying the higher quality stuff. But most of the time you get enough of a discount in the cheaper stuff that you're still better off buying the cheaper stuff. And I think right now it's difficult to see because the expensive, there's such a very broad spectrum of opportunities out there, and it's a question of pricing the growth properly. But I do think that the expensive stuff is objectively, on the numbers that you can pull off the French data website, it's as expensive as it's ever been. And the cheap stuff is not like screamingly cheap. It's sort of basically a little bit rich to its long run average, or maybe a little bit expensive to its long run average. But I still think that's a better opportunity set than the expensive stuff. I think you'd be better off. I think that the best opportunities are the spread, long, short, and in the cheaper stuff. And I think everybody piling into the compounders are going to regret it over the next sort of 5 years or so.
Yeah, well, I think, to make a bond analogy, right, you're basically saying like the spread between investment grade and junk is wider than it's ever been. And now is the time to buy investment grade.
In 2015, I would have said that.
Well, I'm saying today, right? If you just think of compounders as investment grade stocks and value as junk stocks, right? For this analogy, that spread is as wide as it's been, right? In a long, long time. So it's kind of interesting that, people are saying, oh, well, now is the time to buy the investment grade stocks.
What do you think? What do you think has driven Pabrai and Marx to sort of write those letters at the same time? And I guess all of the guys out there who have been the higher quality guys have been riding quite high for a long time. You just give up just too painful to hang out being a deep value guy.
I think that I think there's a real shot that Marx has been sitting around with his son, like he said, and his son has had a lot of success in a different strategy, and maybe it's made him to contemplate something. I believe that letter on face value. I don't see why he would lie about it.
I mean, I guess good for him for having an open mind about that sort of stuff, but experience does count for something. As an investor, like seeing a few cycles should make you pretty wary about what you do at the top of a cycle. Particularly, the two times when you really want to be careful are when you're underperforming and the cycle is long in the tooth and it looks easy to everybody else. Like I really think you need to second guess your second guesses there. If you're at the bottom and or you've come off a big crash and you're in total devastation, maybe this is March 2020. Think about it then, but I don't know. I'm not changing style at this point in the cycle. I think that the opportunity set looks as good as it's ever looked.
Yeah, so I might go a little bit of veggies with steal from Jake a little bit here. I was listening to Adam Robinson. Do you guys know who he is?
No.
Jake, you've heard him?
Mm.
he founded Princeton Review. He's a really interesting thinker. I like how he thinks. And he said that he was telling a story about how a cello, I think it was a cello player, it might have been a violin, it doesn't really matter. At the end of the day, these guys that are insanely talented musicians treat their instruments as if they're limbs. And this guy left his. And it was after a performance when he was traveling. And Adam Robinson's takeaway from that is like, forget about the fact that they may lose their instrument. Their entire well-being is at risk if they're in the mental state where they would lose their instrument. And they do it when they're out of their normal comfort zone and after like a performance. So maybe some stress-inducing activity. I think when you look at like baseball cards ripping, when you look at Bitcoin ripping, when you look at quality ripping in parabolic ways, at least some of quality, and we're all locked in a pandemic, and on top of that, value's underperforming. I think that like capitulating at this time, if someone is capitulating, seems very akin to me to the musician that is traveling and just got done with their stressful performance. And maybe the best thing to do is just sort of put the pencil down for a bit.
Yeah.
You're on till.
That's it.
Yeah, that's right. Now, I don't know, you know, I did not read Marx and get that perception. I haven't read Pabrai's letter yet, mostly because today has turned into a shit show. So I'm on tilt.
You know,
the trick is to know when you're on till. That's the key.
Yeah. I won't be working today.
I can build a model and test a model that just buys these, you know, what we all agree, 35% gross margins plus on average over a period of time, 20% return on equity on average over a period of time, and then buy them when they're cheap, and then hold them until they become egregiously over expensive. So I would say like the free cash flow yield dips below the 10-year, in which case you should probably be holding the 10-year instead of that particular stock. That's my thesis. Ordinarily, that's been a pretty good bet because ordinarily on the 10-year, you've got about 6%. You're currently getting less than 1%. So I understand why there's no other alternative and all of those other theories exist. I think that you know, what we have a tendency to do is we look back at the really great returns that someone who's got from Microsoft, you know, so I've had a few guys on who've talked about, you know, they got Microsoft at the right time. Science of hitting got Microsoft at the right time.
Shout out to TISO.
And there, you know, if you could have bought Pizza, PZZA before it had its big run. You could have bought Sherman-Williams before it had its big run. Ross Stores, all of these names that have had these, you know, multi-year compounding runs where the earnings have gone up materially every year, and you've got the multiple expansion at the same time, which makes you look like an absolute genius because you get this parabolic rise in the stock price, and it's the right kind of return because it's basically tied to the underlying performance of the business. Plus, you got the multiple expansion. But the time to do those things is when they are cheap, and you're not really paying for that. You kind of getting. That's why you get those great returns. If the market knew that those great returns were coming, they'd have bid those stocks up already, and your returns would look more like a market level return. So you still want to be exercising value discipline when you're buying these things. And I think what happens is people get to this point in a cycle and they're like, well, don't go and buy all the cheap stuff, the garbage stuff. Go and buy all this really high quality stuff. And the high quality stuff at the moment, it definitionally meets the definition that I described, but it's stuff that seems a little bit more, it's harder to analyze. It's Intel, which is harder to analyze. It's Biogen, which is harder to analyze. It's not stuff that's like pizza, which was, you know, you had to know that adding garlic salt to the pizza sauce was going to have such an outsized impact on the stock price, which, you know, not everybody did. But it's a simple business.
Right?
Domino's, sorry.
Yeah. I got to tell you, I'm going to plug him again. I talked to him, and I think the audio is lost, which sucks. But Mike Nongap, I mean, the way that I think that the return on investment of time for following some of the proxies and the way that he says to do it, I really think is something that people should pay attention to. And by the way, Toby is the first one that found them off the interwebs and the first request. So tune into the Acquirers podcast because my boy finds
with
gems.
Non-Gap.
Yeah.
Yeah, I got a podcast up with Non-Gap He'll teach you how to read a proxy statement. That's always helpful.
Well, and what he was saying is like how you can find inflection points in stocks based on what the board is doing. And I think that that's a really interesting thing to add an arrow in your quiver or whatever. Anyway, because to your point, Toby, sorry, go ahead, Jake.
I was going to say it's a good kind of initial screening in that there's so many principal agent problems in a publicly traded company. And if you can get around some of those early on, boy, like it just like kind of unlocks a whole lot of other levels.
Yeah. And to Toby's point, like when Science bought Microsoft, everybody was telling them that was like a dead company.
I remember it very vividly. I was at Value Investing Congress hearing, and I heard the pitch for about a year or so. I think it was like 2011, 2010, something like that. I can't remember exactly, but around that kind of period. And what folks forget is that they had their first year of revenue going down, and that was what made it really hard to kind of analyze the opportunity. It was still underlying a great business. It still had those very fat margins and that very high return on equity. Like the return on equity in Microsoft, even now, is just mind-boggling. When you look at something that is that big, generating that kind of return, it just shows you how powerful their moat really is. Like you just can't compete with them in some respects. But it wasn't like an obvious idea. It wasn't I think it was a simple business, but it wasn't like it was just compounding away and you just had to hold it and you got all the compounding. The fact that the revenue backed off for 1 year made it hard, and it was Barmer who was in control. And then I switched over to Satya Nadella, which nobody sort of really knew who he was. Turns out he's one of the great CEOs. He should be he's the real Jack Welch. He should be writing he should be getting all the plaudits that Jack Welch got when he retired. But none of that was obvious at the time. But I do think it's a good argument in that instance for if you're hunting for these things that are high quality and you're remembering to not pay very much for them. That's a good argument for never sell, because once it sort of turned out that Satya did know what he was doing and they started compounding and getting those good returns and buying back stock at appropriate times, the runway all of a sudden looked really long. And you could still be holding Microsoft from buying around 2011, which Science has done, which Alex has done, and good. That's why his returns are so phenomenal. Like good luck, well done to him.
I mean, if you can recognize a Microsoft in that situation and understand what was going to happen with moving to the cloud and getting subscription and all that kind of stuff, you deserve to do really well. I just don't think that there are as many people out there that can do that as are declaring the compound town.
I don't think
badge.
You necessarily have to see how you win in those circumstances. I think what you're doing is you're saying balance sheet's super strong, still a good business, even if the revenue growth is not as consistent as it has been in the past. This is something that you can buy and you can just sort of see. And that's kind of what I think a lot of deep value is. You don't necessarily have to know how it works at the time. You just got to make sure that management is doing the right thing. They have the balance sheet liquidity there to figure out what they're going to do. And it's sufficiently cheap that it's de-risked for you on a valuation basis. So like it's sort of stumbled and it's fallen out of that little hitting window. So like everybody's talking about Standard & Poor's at the moment. SPGI is buying Info, INFO. It's market. Info is expensive and not as good a business as SPGI. So a lot of SPGI guys, and SPGI has been one of those compounders that super high quality business that everybody holds. And now there's some questions because they're slightly over, I'm not a total expert on this, but maybe they're slightly overpaying for Info. I think it's still a good business. I think they'll figure out how to make it work. It's probably a good time to have a go at something like that. This is not investment advice, but I do understand, these are the times when you buy these sort of businesses, when they have that little stumble, but the underlying business is still good. But I understand there are legitimate questions about the acquisition, but I think that they'll figure out how to make it work. And so I do think that SPGI works from here. But it's that kind of thing, like you're looking for these high quality businesses when they have this little opportunity to invest in them. This is what I mean when I say when you build an invincible portfolio, it's sort of working backwards from first we're going to start with really high quality businesses and then we're going to try and buy them as and when they get cheap, but knowing most of the time they never get cheap enough for you to have a swing at them.
Yeah, and I think in those scenarios, like worrying about multiple fade, like over indexing on that concern, doesn't do enough justice to the fact that the business's underlying earning stream has a pretty strong chance of doubling, right? So let's say that the business can double twice over 15 years or whatever, and you give back one of the doubles to multiple fade. What does the rest of the world do in that scenario, right? You're probably not going to lose too much wealth doing that. Now, can you run a hedge fund and have that performance? I don't know. Maybe not. But from an investment standpoint and building wealth, probably do okay.
I never assumed.
You can use the same. You can use Microsoft again as the same example from 2000, where I don't know how much revenue doubled over the next from 2000 to 2014, but multiple fade took away all of your return in that instance.
Yeah.
So, but it's tough. It's not easy. I mean, it's not as easy as I think everyone is kind of assuming right now.
That's why the stock was so scary at the time, because it had gone sideways since 2000, and in addition to that, now revenue was falling off. So you had to be, and
it was huge already.
And it was.
I mean, the things, elephants like tripling in size is not a normal situation, right? It happens to work. Hasn't been. Maybe that's the new normal. I think that's what I would say to give a very Buffett style caveated answer in kind of summing things up. If growth rates are not going to be what they used to be, like if big can keep getting bigger and faster, like returns to scale kind of argument, if rates stay low forever, if we don't allow bankruptcies, so there's no reversion to the mean in businesses and like creative destruction, if we've suspended creative destruction, if valuations remain where they are, then I think this will continue for as long as that goes on. And like you want to be in the growth area if that's true. If any of those things you don't think are necessarily true, then there might be some problems.
I would just say on the assuming the multiple fade, I never assume multiple fade without commensurate. I mean, I assume that the multiple fade is driven by a fade in the return on invested capital. And if you do that, you just assume that these things fade back to normal over 10 years. A lot of these businesses, it's a lot harder to figure out, the opportunity. If you assume that there's no fade in the ROE just keeps on earning basically what it has in the past, and that just keeps on going forever. It's defying the base rates. But yes, that makes valuation decisions a lot simpler now, because you just buy the stuff that's better and you assume that it never backs off, and then you can pay up for it, because in 10 years' time, it's the same quality business. It's just that it's now grown, 3 to 5 times over that period. I find that for the most part hard to believe. For most businesses, that's hard to believe. But I can see how you can make the assumption.
There is some persistence of growth rates in some of these SaaS companies. I was plugging around some VC Twitter today, and I came across an article. But that thing was written in 2012, which is crazy. Good time to make that call. So I don't know. I mean, look, I have no idea. Snowflake might be worth this, right? And if it is, it's good to the people that, bought it.
You get another opportunity to get it a bit cheaper, I reckon.
I would think. It's hard to think that this is the cheapest it's ever going to get.
JT, do you want to do yours?
Yeah.
You got 5 minutes.
Yeah, ready? Go. Sprint to the finish.
Just before, I've had a little. My monitor has just gone down because I run on like the same technology that they sent the astronauts to the moon in 1960. So I'm looking down here, but I'm actually looking at my second monitor. So I'm not like ignoring you guys or anything like that.
I can't even see your picture. I'm on a phone.
There you go.
All right, so this veggie segment is called Ketchup Physics, and it's I actually have a little thing of ketchup here just for fun, and it's Heinz, so that's good. So ketchup is interesting in that if you push on ketchup slowly, it behaves like a solid, like it will resist the force that you put on it. But if you shake it hard enough and it starts to move, it actually starts to behave like a liquid, and then it'll move quickly. It's nonlinear in that way. And so ketchup is what's going on. Like if we look inside here and what's happening at a molecular level, ketchup is made of sieved tomatoes, basically like really highly filtered tomatoes, water, vinegar, and spices. And then there's this other magical ingredient in there that is about 0.5% of the total of it. And it is these long molecules that are made up of chains of linked sugars, and it's called xanthan gum. And it's a common food additive, and it's actually originally was created by bacteria that we then take and harvest from and put this into our things as a thickening agent. But it also actually gets used in the oil industry, if you can imagine, to create this, it thickens drilling mud, which is sometimes what you want, I guess, in the drilling world. Anyway.
I love it going into my body. That sounds great.
I know, right?
Yeah.
So when it's at rest, when ketchup is at rest, these long molecules tangle themselves all up around each other. And so when you put some kind of force on them, they stay together and they resist that force. But then if you get them moving, they start to untangle, and then it will then release basically and turn into a liquid. It'll be more like water. So if you just, as you're kind of shaking the bottle, there's a point where you cross over where enough of them will untangle before they can retangle. And that's when you get a phase change within the ketchup. So if you think about,
it starts to move down the bottle.
That's when it will actually like pour out of the bottle. So the problem when you go to try to when you turn a ketchup bottle upside down and go hitting it on the back of it, the problem is that it's basically like a plug up near the neck, because that's not moving at all. So it's not liquefying. So it's just kind of running up against that. So the trick to pouring ketchup, which most people I think know this already, but is you hold it and you tap on the neck and create the volatility in the neck that breaks up the xanthan gum connections enough to where it liquefies in the neck, and then it will come out much easier. Okay.
That is interesting stuff, Jake.
Thanks. So a couple of things to take away from that. Number one is it's interesting how the time of something, like how long it takes, the duration can have dramatic impacts upon the actual effects and like what happens. So in this instance, the volatility of disrupting the xanthan gum and untangling it, when you get enough of them untangled before they have a chance to retangle, it will liquefy, right? So, but if you're just like not much volatility, or if you spread that volatility out over a very long period of time, you don't get that phase change, right? Because it doesn't untangle enough to liquefy. Now, I was thinking that, like, what if xanthan gum is sort of the equivalent of people's like belief and faith in, the future, in growth rates, maybe the corporate dominance of whatever they're invested in. Maybe it's Fed intervention. Maybe it's that prices can never go down. Maybe it's that rates can never go up. And we have all of these sort of beliefs. And as long as people are together in it and they kind of stay tangled up in it, and there's not too much volatility to shake them from that belief, they can stay as a solid. And like the prices then, like market prices appear very firm, and they appear to be a solid thing to like rest your hat on. But if you introduce enough volatility and you break those beliefs in a fast enough time period for people, you can see a liquidation, just like the ketchup. And now all of a sudden, like all their beliefs go out the window. They're looking to sell, and you get basically like a market run. And it's just kind of the similar analogy to sand on the sand table, or earthquakes building up, or all the million other sort of critical state phase change analogies that are out there. But I thought this was kind of a fun one in the ketchup bottle world, and maybe you'll think about that next time when you try to put ketchup on your fries. And there's there's a good quote. It's actually from Charles Mackey's The Extraordinary Popular Delusions and the Madness of Crowds, which, do you know when that was written, by the way?
It's old. Is it 100 years old?
1841.
1841.
Yeah. That's how old all this is. But he says, men think in herds. It will be seen that they go mad in herds, while they only recover their senses slowly, one by one. So I just think it's interesting to imagine what appears firm. If enough people lose their faith in a short enough period of time, we get phase changes, and just like in the ketchup bottle.
Phase changes in the stock
I
market.
like that. I think Chris Cole would like this too. I tell you what, it's hard to not look at people rushing the capital and not think that some phase changes are going on with how people view the system. Like, I don't know. There's a lot of it's a very interesting time to be alive, to have valuations this high with risk as prevalent as I perceive it to be. But maybe I'm just wrong. That's possible.
I think it's always very hard to know how impactful all of that is, because one of the things about history, when you look back at it, it looks a lot more linear than it actually is in the actual living of it. When you go back, like, one of the things I've been enjoying these, there are these books by Alan First. He's like this, he writes these spy novels, and they're all set in 1939, and they're often in like Paris or in Poland or somewhere like that before Germany invades, and they're always they're not certain that it's going to happen, and they advance. The guy is very good at making all of the arguments that there's good reasons why Hitler won't invade, and there's good reasons why they can't, and why the Maginot Line will stand up, and they advance all these things. And as you're reading it in the book in the context of 1939 or 38 or before anything happens, it all sounds perfectly reasonable. It's not, you as a reader, because you know how it all ends, you're always sick.
Yeah.
But I think that a lot of history is like that. You forget how not obvious it was at the time. And I think, I saw a good tweet the other day. Someone was describing someone went through a whole lot of old Oppenheimer research reports and was talking about what it was like being an investor in the late 1990s. And they said everybody basically knew it was a bubble. Everybody knew it was over expensive, but it wasn't even the internet stocks that were the stuff that were the most bullish. There were, we talked about this before. Yeah, it was large cap. It was Microsoft was one of them. GE was another. There were a lot of these businesses that were very good businesses, very good returns on equity, very good margins, all that sort of stuff. And they got too expensive. It's the same thing we see repeatedly in the markets. The same Nifty 50 story from the 60s and 70s. You could pay any price for these things and still do okay. I think
they did outperform, though. You just had to live through the drawdown.
The Nifty 50 outperformed eventually?
Yeah, I think it did. I think it just started, which is maybe another element of where we may be, right? You might think that would be a full long cycle comment.
How long did it take you to get back from? I mean, a lot of those were just absolute monster drawdowns, like 70-80% plus
for a long time
for inevitable companies. Whew.
I think, is that also true for Microsoft? Has Microsoft now sort of, from 2000, I think it's now crested. It's like you're now sort of you've been paid to hold on to Microsoft. I just think that if you're a value guy, you had a bet. You knew not to be in it in 2000, and then you had a signal. At least you had people saying get into it in 2011. And the guy who bought it in 2000, his returns are probably okay, but the guy who bought it in 2011, his returns are spectacular. And you're going to get those opportunities. That's why I don't think anybody needs to reach up. Like, if it's too hard, if it's really an effort to do the analysis, then it's probably not the right opportunity. You just need stuff that's like, yeah, it's obvious. Like, not a lot has to go right for this thing to work. It's a good quality company and it's too cheap. And if I stick it in and forget this for a few years, it's probably going to work out.
Are you saying Buffett would say, like, wait for your fat pitch? Jeez, it's like he's got a quote for everything.
It's almost like, yeah, it's the shame of it is going back and reading those old letters and realizing how smart that man is. Every single time I go back, it was my inability to learn, not his inability to teach.
Yeah.
Throw your questions in, dudes. We're all a bit discombobulated here.
I had a real quick thought on that. Well, fuck it. I'll just talk about it later. I'm done. I'm not talking about it now.
What? This is a podcast. That's what it's for.
Ketchup related? Only comments.
No, I don't know why. Something that you said triggered something, but now I feel like it's forced. So I'll save it. It's over. The moment's gone.
There's a comment here. Buffett doesn't market time. I'm going to take that as a question. So I was thinking recently. I've been. I'm going to throw it up. In conversations with a few guys, Value Stock Geek, notably one of them, pointed out that you get this, if you look at the fear and greed indicator, that it gives you this pretty good opportunity every year, basically when the market falls over, as a sign to go in and buy some stuff. And I thought that's probably a pretty good approach to this business. If you got your list of really high quality businesses that you want to own, and the only time that you transact in them every year is during that period, then you're probably going to do okay. You likely outperform the average holder of them because you're buying them at the right time. And then I found some comment of Buffett's where he was like, I can see that, because what he's doing, what Buffett is explicitly doing, is wonderful companies. He says fair prices, and I think that that's because he's buying some of these companies privately. He doesn't want to tell people that he's gouging their eyeballs out. But in the stock market, where he doesn't have to be polite to anybody, he's definitely gouging their eyeballs out. He's wonderful companies at wonderful prices. He just waits for them to get too cheap. And Apple's a classic example of that. When he bought Apple, it was unusually cheap, as it seems to get every 3 years or so. So I think that what he said in this little comment was, there's no point doing what I've just described, where you're waiting for the fear and greed indicator because it's market timing, and he's explicitly not a market timer. He's just trying to find those opportunities when they come in. He only wants to buy the high quality ones, however you define that, but he's using return on equity, as he said lots of times, and then he's buying them cheaply when they come into the cheap bucket. It's just, you need extreme discipline, extreme patience to do it, but if you can do it for 50 years, you buff it.
What's the difference between that and market timing?
Well, he's doing it on a case-by-case basis, I guess, rather than like me saying, wait for the fear and greed indicator to tick below 20 when the market does its annual sell-off. Market goes on sale once a year, basically, and has done pretty regularly. And if you wait for that opportunity and you deploy all of your capital when, you're like the pig farmer, the apocryphal pig farmer who comes off his pig farm once a year when there's panic and does his buying.
So you want to be a securities timer, but not a market timer?
No, I don't. I'm saying I thought about it. I don't think
it's a real question.
Approach. I don't think it's a bad approach. It is every time I think of something that might be a good approach, and I go and read some Buffett, and I'm like, oh, that's right. Yeah, don't want to do that.
Yeah, I said that in 1973.
Yeah, he told you not to do it already. That's why I've got What Would Buffett Do? I got that little poster. I put it up, and every time I think about buying something that I have to go and explain it to Buffett, I'm just like, nah, there's no point doing that. I could never explain it to him. I think that's more on a discretionary basis. Like the quantitative deep value, that's always going to be pretty good at generating returns. But if you're going to take these like singular swings where you only buy 1 or 2 positions a year, you want to make sure that it just ticks every box for you at the time that you do it. And I couldn't put Biogen or Intel into something like that, because if I went and tried to explain it, I just can't explain the businesses well enough.
Yeah.
And the risks are real.
Yeah.
You have what would 1965 Buffett do for your other side? For the quant side?
Yeah, well, clearly he's if he could do it, I'm sure he could still do it. If he's said before, if he had $1 million, he'd be getting 50% a year. Harder than it looks for it. I don't know if you'd really be getting that. Maybe in a 65 market.
Yeah, I think that's right. That said, microcap's got to have some good, opportunities in it. Some of these structurally smaller things. Shout out to Ian Castle. Happy birthday.
Yeah.
Happy 40th, Ian.
Birthday.
Good job.
Nah, you didn't have to put his age on blast.
He tweeted it out.
Tweeted it out. Well, I'm just saying, not everybody's on Twitter.
He tweeted it out. It's got like 1,000 likes on it.
I bet your back hurts.
It's not like it's not a state secret. Sorry, folks. I'm having trouble watching the questions. I'll toss this one out to the boys, but I don't know. Will Peloton acquire Equinox? This is probably a good question for Bill.
I don't know. I've been like poking around in my head if Peloton and Planet Fitness make more sense to merge, or not merge, but like form a JV. The amount of people that could be served by Peloton's app in Planet Fitness makes a whole lot more sense to me than Equinox. I mean, Equinox is like somewhere to go and see and be seen and pay too much for a trainer that keeps you fat. No, I'm kidding. They're very good looking people there. But I don't know that that's the I don't think that's the match. No. If you're Equinox, why would you undercut your trainers like that? You're making like $100 an hour on training sessions, and you're going to outsource it all to Pelotons? That doesn't make sense to me. I guess Peloton could, in theory, buy them, but then you're entering the gym business. I don't know.
Aren't you looking at Planet Fitness?
I am looking at Planet Fitness, yes.
So the gym business is good enough for you, but not good enough for Peloton?
I mean, I think that selling $10 memberships to people that never redeem their gym membership isn't exactly the same business as Equinox. And I'm not looking at it because I want to buy it. I'm looking at it because I'm intrigued by what makes it work. For instance, like a lot of their franchisees own 3 stores or more. And considering the fact that I left a franchise system that is fairly successful, but most people only own 1 franchise, I'm sort of intrigued by what does this franchisor do that enables people to be successful? Or is it something in the franchisee base? Or like, is it cultural? Like that's the stuff I'm not particularly interested in that stock.
Did you say the average franchisor owns 3 franchisees? Or the other
franchises? Yeah, man.
Really?
Yeah, the franchisees. I don't know the stat off the top of my head, but like the vast majority of their stores are owned by franchisees that own 3 or more.
Planet Fitness hands out pizza at the gym.
What?
Planet Fitness hands out pizza at the gym.
Yeah, dude, and like bagels, and they have Tootsie Rolls on the welcome mat, like on the welcome counter. It's absurd.
To keep you coming back?
Don't know. It's like a no
you earned it.
Zone.
That's genius.
Dude. And like you're not allowed to throw around a lot of weight. They like honk a horn at you or something. It's like an alarm telling you that you're a grunt.
So they're literally getting people in there and then not letting them get fit. Like, so you got to keep on coming. You can't lift heavy weight and you got to eat a whole lot of carbs while you go in. And it's $10 a month. So.
Yeah, or $22 if you join their Black Card program, and then you can bring a guest at any time, and you can visit any location.
And it's all you can eat pizza.
That's right. The average member spends something like $240 a year there, off the top of my head. But you look at like the CAGR on stores and same store sales and memberships, like it is like a very impressive marketing machine.
That's hilarious.
I want to figure out what the hell how they crack that code. It's intriguing to me because I want to be able to recognize that pattern in another industry. It doesn't seem like the gym industry would be particularly easy to do that in.
Bill, we're just about to run out of time, but I got a quick question for you from somebody. I took it off the screen, but it was, why aren't 0% interest rates bad for banks?
I mean, they're not great. I think if the bank can borrow at -2, though, which is sort of laughable, but it happens in Europe, they can still make money.
Yeah, okay. It's not a healthy system if that's happening, but yeah, all right.
Yeah, I mean, I don't think that where we're going is particularly great. I just don't think I think if people think low rates, therefore banks die, I'm not sure that that's correct.
Does some of the experience from Europe make you nervous about that Deutsche and UBS?
Yeah, I don't think I own any banks outside of a look-through exposure via Berkshire right now, because I watched Wells rip and did nothing about it because I tax loss sold. That felt great.
Thanks for the kind super chat, Investor Flock. Folks, that's all we got time for. Well, next week I think we'll all be back where we normally are, and I'll get my monitor fixed up so I'm not staring down here the whole time.
I'm going to be here.
JT's now a lifestyle blogger from somewhere in the
Caribbean. Yeah.
That's right.
Check out his Instagram channel.
I'm not on Instagram.
I'll never be in this house again after Friday, so that's that.
Sad?
Unless you can't find that deed.
I'm a little sad. I'm more sad to be leaving Chicago than the house. I mean, I'm looking at snow right now, and I left in shorts, so I'm ready to get back home.
Good luck, mate. Safe travels.
All right, take care of yourself, boys.
See you, fellas.
Cheers.